welcome and get ready to dive into the thrilling world of investments, where numbers dance, money talks, and the unexpected always keeps us on our toes. Real estate investment trusts, or REITs, are generally not the most exciting thing when it comes to stocks, and honestly, they aren't. But in investment, boring can be a good thing. In this video, we will cover Realty Income, a strong company and maybe one of the most durable REITs in the field. While it may not have the glamour of cloud computing or AI, do you know Realty Income has consistently outperformed both S&P 500 Index and NASDAQ in the last 25 years? And it has done it with less than half of the volatility of a typical S&P 500 stock. Does this boring stock sound interesting to you now? Go ahead and hit that like and subscribe button below, as we prepare to dive deeper into the world of Realty Income. To begin, let's quickly discuss Realty Income and its overall background so everyone here is on the same page. Realty Income was founded in 1969. The goal was simple: to generate a reliable monthly income for investors. Their real estate portfolio started with a single Taco Bell property sale-leaseback acquisition that year and has grown to over 13,100 properties in all 50 states, as well as Puerto Rico, the United Kingdom, Spain, Italy, and Ireland. The majority of Realty Income's properties are occupied by a single tenant. Over 80% of the company's rental income originates from retail tenants, while its portfolio also has industrial, agricultural, and gaming properties. Tenants enter into long-term, triple-net leases that require them to cover taxes, insurance, and maintenance costs. These leases usually include annual rent increases as well. Nearly all tenants can be categorized into one of four groups. 1. Non-discretionary. These are retailers offering essential goods. For instance, grocery stores make up roughly 10% of the portfolio. 2. Discount-oriented. These are retailers selling products at affordable prices. Dollar General, the largest tenant for Realty Income, is an example. 3. Service-based. These retailers provide services rather than tangible items. Businesses like restaurants and fitness clubs fall into this category. They are resilient against e-commerce challenges. For non-retail, these are companies like FedEx, a top tenant for Realty Income, is not only recession-resistant, but can also benefit from the e-commerce boom. In essence, Realty Income's diverse portfolio and lease structure are meticulously designed to ensure consistent, growing income over the years. As a result, the company has maintained an impressively high portfolio occupancy rate. Tenant occupancy has consistently hovered around 99% and has never dipped below 96%, allowing the company to successfully navigate through both the financial crises in 2008 and COVID pandemic in 2020. Here is a more detailed look at the Realty Income's tenants. Just browsing through the list, you will find everyday household names like Dollar General, Walgreens, Dollar Tree, Walmart, AMC, 7-Eleven, FedEx, La Fitness, and many, many more. You may have not heard of Realty Income before, but I am sure you have stepped into one of those stores that leased from Realty Income. Now, those tenants are well diversified across different industries, but more importantly, those are businesses that are going to be around whether the economy is good or in a recession. Nevertheless, Realty Income stock, ticker symbol O, has been under pressure since the start of 2000, when COVID pandemic hit. As we got through that period, the stock price had bounced back above $70 per share. Then when the Fed started to raise interest rates sharply in 2022, the price was under pressure again. We know that real estate investment trusts use a lot of debt to buy properties in their portfolio. So when the debt goes up from 3% a few years ago to today's 7% rate, it is putting a lot of companies under pressure. This brings me to my point today. Now with this round of interest rate hike getting close to an end, things should look better for Realty Income. And this may be the best time to buy its shares at a discount. After all, Realty Income is the largest net lease by asset size and has a very strong track record of delivering shareholder returns. Since their IPO in 1994, they were able to deliver 14.2% compound annual total return. In comparison, the S&P 500 index returned 9.5% annually with dividends reinvested. Currently, this stock offers a dividend yield of 5.46% and has a beta of 0.79. A beta less than 1 indicates the company is less volatile than the broader market, so 14.2% compound annual return with a beta of 0.79 look really attractive to me. Of course, each person's risk tolerance is different, but for people who are looking for stable, high dividend income which can produce strong growth over time with less volatility, Realty Income remains a strong candidate in the portfolio. A few weeks ago, Realty Income released their operating results as of June 30, 2023, which shows their net income available to common stockholders was $195.4 million, or 29 cents per share. Normalized FFO available to common stockholders was $688.3 million, or $1.02 per share. The company invested $3.1 billion in 710 properties and properties under development or expansion at an initial weighted average cash lease yield of 6.9%. Realty Income also raised $2.2 billion from the sale of common stock, with a weighted average price of $61.89 per share. It also issued $400 million senior unsecured note maturing December 2028 at 4.7% and $600 million senior unsecured debt maturing July 2033 at 4.9%. Commenting on the second quarter results, Realty Income CEO Sumit Roy said, "I am pleased with the results our team delivered in the second quarter. Our performance continues to be driven by our diverse and high-quality portfolio of leading clients. Our global pipeline of investment opportunities with favorable risk-adjusted return profiles remains active. During the quarter, we closed on $3.1 billion of investment volume, and we continue to evaluate and expand into new geographies. Given our current liquidity position and healthy investment pipeline, we are increasing our acquisitions guidance to over $7 billion. Combined with our well-performing real estate portfolio, which finished the quarter with a 99% occupancy rate, our business remains positioned to offer investors consistent cash flows and compelling risk-adjusted returns." Beside the financial statements, there are two things worth pointing out from the earnings release. First is that one of Realty Income's tenants, Cineworld Group, filed for bankruptcy in 2022, and this puts a negative impact on current earnings. Cineworld represents about 1.1% of Realty Income's portfolio rent. According to Realty Income, as of June 30, 2023, Realty Income collected approximately 99% of contractual rent across our entire theater portfolio. So as things get settled, financials should look better for Realty Income in the upcoming quarters. The second thing to note is that Realty Income announced the 103rd consecutive quarterly dividend increase. The annualized dividend amount was $3.066 per share. This also makes the 121st increase in the amount of the dividend since the company was listed on the New York Stock Exchange in 1994. Putting things together, although macro factors like interest rates are impacting the company's cost of borrowing, we see from this recent earnings release that Realty Income was able to weather higher interest rates as well as tenants' bankruptcy thanks to its well-diversified portfolio. As I said before, most likely the rates have peaked or are close to the peak in the U.S., as the Fed is going to take a wait-and-see stance to assess the consequences of this round of rate hikes. The macroeconomic backdrop is expected to be more favorable for Realty Income. So for investors, given Realty Income's stock price has been flirting with a new 52-week low over the recent trading days, it represents an opportunity for dividend growth. With dividend yield well above 5% and a long track record of dividend growth, Realty Income is safeguarded by a well-diversified portfolio and has a path to acquire more high-quality companies for future growth. In my view, Realty Income appears well-positioned to weather any challenges the economy may pose in the short term. If you're already invested in dividend income ETFs like JPEI and SCHD, adding Realty Income into your portfolio can provide valuable diversification, considering that REITs are absent from those dividend ETFs. However, I'm eager to hear your perspectives. Given the current levels, do you think Realty Income is a buy? Or do you prefer to wait a bit longer to pull the trigger? Share your thoughts and comments below. If you enjoyed this video, make sure to drop a like and subscribe for more future content like this. Thanks as always for watching. See you next time.